Welcome to the Deep Dive. Today we are Talk Tickers, and we're cutting straight through the noise from Conagra Brands' ticker CAG.
That's right. We're diving into their Q1 fiscal year 2026 earnings call. Came out pre-market today, October 1st, 2025.
And the market reaction was, well, pretty immediate and positive.
Yeah.
The stock shot up.
It really did. Closed up over 5%, 5.41% to be exact, on a pretty high volume, too. You definitely felt a sense of relief there.
Yeah, it suggests expectations might have been, let's say, muted going in.
Exactly. So our job today is to unpack the numbers, the management commentary, and figure out why the market felt that relief, especially given, all the talk about macro headwinds. They managed to hold their full year guidance, too.
Okay, let's jump right in with the results snapshot then. What were the headlines?
The big one was the bottom line beat. Adjusted EPS came in at 39 cents.
The 39 cents, okay. And the consensus was around 33 cents.
Yeah, roughly $0.33. So a solid beat there. GAAP EPS, for context, was 34 cents.
Said revenue.
Revenue was $2.63 billion. That also just nudged past the estimate, which was about $2.62 billion.
So EPS beat strongly, revenue just barely beat. What about organic sales?
That's where it gets interesting. Organic net sales were down, but only just barely, down 0.6%.
Okay, less than 1% decline.
Right. And that was driven by positive price mix, which added 0.6%, almost completely canceling out the volume decline of 1.2%.
As the volumes are still down a bit, but pricing is holding up, or maybe even helping on the mix side.
Exactly. Considering the environment, holding organic sales nearly flat is a pretty stable performance.
And stability seemed to be the message from management.
Very much so. They talked about solid progress, focusing on reshaping the portfolio. But the thing they really highlighted, the big accomplishment for Q1.
Let me guess, service levels.
You got it. Back up to 98%. They stressed that point. That was crucial groundwork for the rest of the year.
Okay, crucial, but it often comes with a cost.
Yeah.
Let's dig into the financials a bit deeper. Where did the pressure show up? Because it wasn't really on the top line.
No, it was all about the margins. Despite the sales beat, the profit picture wasn't quite as rosy. Adjusted operating margin fell 244 basis points year over year.
Oof, 244 basis points. Down to what level?
Down to 11.8%. And adjusted gross margin was also down 153 basis points to 24.4%.
So significant margin compression there.
Definitely. And adjusted EBITDA reflected that too, dropping 16.4% year over year to $441 million. So the sales held up okay, but profitability took a hit.
Where was that hit concentrated? Did they give segment details?
They did. The main drag on sales specifically was grocery and snacks. That segment saw sales decline 8.7%, and organic sales were down 1.0%.
Okay, so grocery and snacks took the brunt of it. What about refrigerated and frozen? That's a big area for them.
That was the brighter spot, relatively speaking. Sales were down slightly, 0.9%, but organic sales were roughly flat. Holding the line there is pretty key for their strategy.
Right, especially if they're banking on frozen for growth. Now, you mentioned costs earlier. What about cash flow? Sometimes that tells a different story.
It certainly did this quarter. Free cash flow, or FCF, was actually negative.
Negative by how much?
A negative $26 million. And that's down $162 million compared to last year. So a big swing.
Wow, okay. Negative $26 million FCF. That usually gets investors nervous. How did management explain that?
They framed it as a planned transitory issue. The reason given was the inventory rebuild needed to support those restored service levels.
So they spent cash to build inventory back up to that 98% service level after maybe running too lean before.
Precisely. They essentially said, look, we had supply disruptions, we ran down inventory, now we need to rebuild it to make sure we can actually meet demand and execute our plans for the rest of the year. It was positioned as a necessary investment.
Okay, that makes sense strategically, but negative FCF is still negative FCF. Do you buy the transitory argument, or could this point to deeper issues with costs or inventory management?
It's a fair question. I mean, you always have to be a little skeptical. But based on their commentary and the clear link to the service level restoration, the transitory explanation seems plausible this time. They needed the product on hand to drive the volume they're aiming for in frozen and snacks in the second half. It feels like a conscious trade-off.
Sacrifice cash flow now to enable sales later.
That seems to be the logic. And importantly, the balance sheet looks like it can handle it.
All right, let's check on debt. How's the overall balance sheet health?
Pretty solid, actually. Net debt was down 12.3% year over year, sitting at $7.6 billion.
And leverage.
Net leverage is at 3.55x, still very much within reasonable bounds, and they reaffirmed their commitment to paying down debt targeting $700 million for this fiscal year, FY26.
Plus some tax benefit.
Yeah, another $75 million expected from some tax favorability. So despite the FCF blip, the deleveraging story seems intact, which is, a positive sign.
Okay, so Q1 beat, margin squeezed, cash flow negative due to inventory rebuild, but balance sheet okay. Let's shift to the outlook. What are they telling us about the rest of FY26?
Well, the big news here is they reaffirmed the full year guidance. No cuts.
Holding firm despite the pressures. What are the key numbers again?
Organic net sales growth targeted between -1% and +1%. So basically flat-ish for the year.
Okay, and the bottom line?
Adjusted EPS target remains $1.70 to $1.85. An adjusted operating margin expected between 11.0% and 11.5%.
Sticking to the plan. That shows some confidence. But what are the assumptions behind that guidance, especially on costs?
Yes. The big assumption is inflation. They're baking in total COGS inflation in the low 7% range for the full year.
Low 7% range. That's still really high for a consumer staples company.
It's brutal. Yeah, and the breakdown is really important here.
How does that 7% break down?
Okay, so core inflation, think ingredients and packaging, is expected slightly above 4%. That's mainly driven by volatile stuff like beef, pork, turkey, eggs, animal proteins.
Right, the usual suspects lately. But 4% doesn't get you to 7%. What's the rest?
This is the kicker. An additional roughly 3% hit to COGS is coming from tariff inflation.
Wait, tariffs alone are adding 3 points to their COGS inflation. 3%.
That's what they said. It's a huge structural headwind for them specifically. About half of that 3% hit comes from tinplate and aluminum think cans.
Affecting a huge chunk of their portfolio.
Absolutely. And another 30% of that tariff impact comes from certain imports from China. So it's not just broad inflation, it's very specific cost pressures they have to manage.
Which explains why they need a very specific strategy. You mentioned something about horses for courses.
Yeah, that's what they called their dual strategy for the rest of the year. It's basically about treating different parts of the portfolio differently based on these pressures.
Okay, break that down. What are the two approaches?
So first, you have the heroes. These are the volume focus areas, primarily frozen and snacks. That's about 70% of their retail business.
And the strategy there?
Invest to drive volume, leverage those restored service levels, push innovation, get product on shelves, get promotions going. They're already seeing some success here. Mention share gains in things like frozen desserts, hot dogs, canned tomatoes, multi-serve frozen meals.
Okay, so push volume in the big categories. What's the other horse?
That's the pricing focus. This applies more to the staple categories, especially those hit hard by the tinplate tariffs, like canned goods.
So less focus on volume there.
More focus on maximizing cash and protecting margins through inflation-justified pricing. They acknowledged volume might take a hit in these areas, but they need to pass through those specific tariff-driven costs.
Makes sense. A targeted approach. You mentioned frozen being key. How critical is that segment's recovery?
It sounds absolutely vital. Management basically said the category goes as Conagra goes. They feel their temporary share loss last year was purely due to being out of stock because of service issues.
Now service is back, so they expect to regain that share and drive category growth.
That's the plan. And innovation is central to that. They specifically called out the new premium Dolly Parton line frozen meals and desserts.
Ah, yes, the Dolly line. Getting a lot of buzz. How's that performing?
Apparently, performing strongly. And importantly, it's helping improve the mix because it's a premium, higher-priced offering.
That's interesting. A premium celebrity line for a company often associated with value. Is that a sustainable strategy, though? Can Dolly Parton really lift the entire Conagra ship long-term? Or is it more of a niche boost?
That's the million-dollar question, isn't it? Management seems to think it's part of a broader strategy to use innovation to improve the overall mix, attract different consumers perhaps. But you're right, they have to balance that premium push with their core value proposition, especially with the consumer behavior they talked about.
We'll come back to the consumer. But first, looking beyond this year, FY26. Those margins took a big hit. How do they plan to get them back up over the longer term?
They laid out 5 main levers they're pulling for margin recovery after FY26.
Okay, what are they?
First, just continued productivity gains, the usual cost-saving efforts. Second, they're hoping for eventual relief from inflation, getting back towards that historical 2% core rate.
Hope is not a strategy, but okay. What else?
Third, supply chain resiliency investments. They specifically mention building out their own chicken processing capacity to reduce reliance on expensive third-party co-packers.
Bringing more production in-house where it makes sense.
Exactly. Fourth is the benefit from pricing lag. Basically, the full margin benefit from price increases taken now will flow through more completely later on.
And the fifth lever. This one sounded interesting.
Yeah, this one's potentially transformative. It's a new initiative focused on reengineering core work processes using technology, explicitly mentioning AI.
AI for cost reduction at Conagra.
Seems so. Not just tinkering around the edges, but looking at fundamental process redesign to drive efficiency and reduce costs in a way that's maybe less dependent on commodity cycles or pricing power. It's ambitious.
Definitely something to watch.
Okay.
Okay, let's bring in the broader context. What did they say about the consumer?
No big surprises here, really. They acknowledge the barbell economy persists. Value seeking is very pronounced, especially among lower income households. People trading down, maybe delaying some purchases.
So how does Conagra position itself in that environment?
They emphasize that their portfolio already offers strong value choices, and that this value-seeking behavior is actively informing their innovation pipeline. So expect not just premium stuff like Dolly, but also enhanced value offerings to capture that large segment of the market.
Balancing act, like you said, and competitively. Staples haven't exactly been market darlings lately.
True. Staples, as a sector, have generally underperformed the broader market. Management didn't shy away from that.
Did they comment on their ability to take those necessary price increases, especially the tariff ones coming in Q2 without losing too much volume? Pricing elasticity must be top of mind.
Absolutely. They said they track elasticities weekly, and importantly, they're not assuming anything heroic in their plans. They need to take the price, they know volume will react, but they felt validated because they said Conagra's average elasticity has actually been a bit better than most peers over the last year or so.
So they think they can manage the volume hit relatively well.
That's the message. That relative resilience gives them confidence heading into Q2 when those tariff-related price hikes really start hitting the shelf.
Okay, so the market rallied on the Q1 beat and the guidance hold. What should we watch for as near-term catalysts now?
It's all about execution in Q2. First, can they translate those 98% service levels into real merchandising gains and volume momentum, especially for the holiday season in frozen and snacks?
Execution on the heroes strategy. Got it. What else?
Second, we need to see progress on their cost savings programs hitting the run rate they expect. And third, any news or changes related to those tariffs, either positive or negative, would be a major factor.
And given the stock's underperformance over the past year.
Right, there's potential for what's called mean reversion. If they execute well on this volume recovery plan, the stock could snap back just because it's been beaten down relative to fundamentals or historical levels.
Okay, makes sense. Which brings us nicely to our favorite segment.
This is not financial advice, where we pitch an outrageous, but maybe, just maybe, plausible trade idea.
And today's pitch is built right on top of that execution story we just discussed. We're acknowledging the risks, right? The Q2 margin pressure from inflation lag and those tariffs is real.
Oh yeah, definitely real risk. But this trade bets that the groundwork laid in Q1 pays off faster and bigger than the market is currently pricing in.
So the trade is go long CAG, targeting Q2 results. We're calling it a potential triple play catalyst.
Okay, let's lay out the catalysts. Catalyst number one. That 98% service level isn't just a number. It fully unlocks merchandising and promotion, driving volume momentum in frozen, and snacks the heroes much faster and stronger than expected in Q2. Volume surprises to the upside.
Catalyst number two. Those necessary price increases on staples, the ones driven by tinplate tariffs, show the better than peer elasticity management talked about. Volume holds up better than feared, and margins stabilize, or maybe even slightly improve, earlier in Q2 than the street anticipates.
And catalyst number three, the Dolly Parton effect writ large. The premium innovations, led by Dolly, but maybe others too, accelerate that positive mix shift more dramatically than forecasted. This boosts organic sales growth, maybe even pushing it above the low single-digit decline people expect for Q2.
So the bet is basically that strong execution, recovering volume, decent pricing power, and positive mix shift, all converging Q2, overcoming the macro gloom and tariff pain faster than anticipated.
Exactly. It's a bet on management delivering on the plan they just laid out, and the market underestimating the immediate impact of getting service levels right.
A high-conviction bet on execution. Okay, let's recap the deep dive then. Conagra delivered a key Q1 beat, providing market relief.
They reaffirmed guidance despite some pretty hefty inflation, particularly those unique tariff pressures.
And they laid out a clear horses for courses strategy. Pivot to volume in frozen and snacks now that service is restored, while carefully managing pricing in tariff-hit staples categories.
And looking longer term, they have multiple levers for margin recovery, including productivity, supply chain investments, and this new interesting focus on using technology and AI for process reengineering.
Which leads us to our final provocative thought for you, the listener. Management talked quite a bit about AI and technology being a key future lever for margin improvement.
Right. So considering the scale of the current pressures, that 7% OGS inflation, the structural 3% tariff hit, here's the question. What percentage of their eventual margin recovery will actually come from these futuristic AI and tech optimizations versus the more traditional stuff like inflation eventually cooling off, better commodity buys, or simply more price increases?
Can the new tech solutions truly move the needle enough to overcome such massive old-school cost headwinds? Something to think about.
Definitely something to mull over.
That's all for this deep dive. Thanks for tuning in.